Hello everybody, at this time we are talking about the payback period. Individuals and corporations invest their money with the intention of getting it back and realizing a positive return. The shorter the payback, the more attractive an investment becomes. The payback period determines how long it will likely take for it to occur. It is the length of time before an investment reaches a break-even point. Determining the payback period is a simple calculation. And then we move to features of payback period. The first, the payback period is a simple calculation of time for the initial investments to return. Second, it is used in combination with other techniques of capital budgeting. Owing to its simplicity, the payback period cannot be the only technique used for deciding the project to be selected. And third, it ignores the time value of money. All other techniques of capital budgeting consider the concept of the time value of money. Time value of money means that a rupiahs or dollars today is more valuable than a rupiahs or dollar tomorrow. So other techniques discount the future inflows and arrive at discounted flows. And then what is a good payback period? A good payback period is generally one that allows a company or investor to recover their initial investment as quickly as possible. The first, shorter payback periods. Shorter payback periods indicate a more attractive investment because the sooner a project's cash flows can offset its upfront costs, the faster a company can start generating profits. This means invested capital can be freed up faster and allocated towards other opportunities. And then second, longer payback periods. Longer payback periods tend to be less attractive as they indicate a project will take longer to pay for itself. Because it takes longer to see returns, there is less opportunity to reinvest the funds in other profitable ventures. For that reason, longer payback periods are considered less profitable and higher risk. And then why is knowing the payback period important? There are always risks involved in making large corporate expenditures. Companies often need to choose between multiple alternatives when deciding where to spend their hard-earned capital. They also need to know whether a contemplated purchase is a good deal. Budgeting capital is a vital task in business finance. It is important that the decision makers in a business strategically compare different projects or potential investments to determine which is most likely to be profitable in the shortest period of time. One way to accomplish this is by calculating the payback period. In general, a shorter payback period makes for a more attractive investment. Companies want to recover the initial cost of an investment or project as quickly as possible. However, the time horizon and the company's financial circumstances also need to be taken into account when comparisons are made. And then how to calculate payback period. The payback period is a fundamental capital budgeting tool in corporate finance and perhaps the simplest method for evaluating the profitability and feasibility of understanding a potential investment or project. Conceptually, the payback period is the amount of time between the date of the initial investments and the date when the break-even point has been reached. The break-even point refers to the threshold of which the amount of revenue produced by the project is equal to the associated costs. While there certainly are exceptions, a large portion of companies, especially those that are publicly traded, tend to be more short-term oriented and focus on near-term revenue and earnings per share targets. For a public company, the stock price of the company could falter if near-term sales or profitability goals are not met, as the market is unlikely to uphold the current valuation and is because management claims to be operating with a longer term horizon in mind. Each company will internally have its own set of standards for the timing criteria related to accepting a project, but the industry that the company operates within also plays a critical role. And then, what are the advantages of the payback period? There are several advantages to the payback period approach, which are noted. The first, useful for small investments. The payback period is especially useful for a business that tends to make relatively small investments and so does not need to engage in more complex calculation that take other factors into account, such as discount rates and the impact of throughput. And then second, risk focus. The analysis is focused on how quickly money can be returned from an investment, which is essentially a measure of risk. Thus, the payback period can be used to compare the relative risk of projects with varying payback periods. Third, calculation simplicity. The payback concept is extremely simple to understand and calculate when engaged in a rough analysis of a proposed project. The payback period can probably be calculated without even using a calculator or electronic spreadsheet. And then, what are the challenges in the payback period? Firstly, the payback period considers the cash flow up to the point where the business regains the initial investment and it doesn't view the earnings made over and after that point. Thus, it fails to see the long-term potential of the business because the focus is only on the short-term ROI. Secondly, it is crucial to remember that a product or service needs enough time to grow and reach a wide range of audiences. Often, companies overlook this, which results in missing out on profitable opportunities. Lastly, it is not always possible that you will recover the initial investments as soon as it is estimated. Sometimes the pandemic can make it longer to regain the instruments of investment made due to circumstances, and the payback period framework leaves out such a scenario. I think it is enough. Thanks for watching.